Good morning, everyone. Welcome to this update for global stocks and commodities for the 6th of May. We have a really highly unusual market and has really been the case all year in that we've got some incredible positives and some negatives as well. And whilst markets nearly always have these various cross currents flowing through them where there are contradictory signals, I can't recall it ever being quite as stark and obvious as it is at the moment because there is so many very, very positive reasons why the market should go up. And yet at the index level, it's not. It's just basically going sideways. But as I'll show you, there are certainly stocks that are going up very, very strongly. So we also have this incredibly divided market where some parts are doing nothing and other parts are just roaring ahead. So let's jump in and take a look at this update. I'll try and give you a little bit of a direction as to where to from here. Certainly, I know where the market should go, but I always remain open-minded and am guided by the price action. So I want to take a look at the current sentiment, which is really very poor, versus the reality of where prices should be going. The normal stock and commodity look, of course, and portfolio analyst last week, I did some more on the strongest industry groups in America, and it's really revealing how starkly there are terrific opportunities if you know which corner of the market to look in. So just on market sentiment, market sentiment can be used as a very powerful contrarian indicator. There's no question about that. If you want to, stick with the crowd and think as everybody else does, then you're going to get what everybody else does, which is extremely average or even poor market results. And we've got this really highly unusual set of circumstances where investor bullishness is almost at record lows. I mean, sentiment really is dreadful at the moment. Fund manager commitment to the market is relatively low. They've got lower holdings and more cash than would normally be the case, particularly at the end of a 9-year bull market. Pardon me. But just consider the positives here. The trend is intact. The uptrend is intact, even though we've had this very volatile period with the indices. They haven't yet broken down from their 200-day moving averages, and so they are still in uptrend. The Russell 2000 small caps are still very strong, as we'll see. The advanced decline line is near all-time highs. So this is the number of advances versus the number of decliners. Also, the market breadth is still quite relatively strong. And of course, earnings season now, we've got through the bulk of it, and the results have been terrific. Nearly 80% of stocks that are reporting have beaten the averages, and the outlooks are still very solid. So companies are still pointing towards really quite quite solid future earnings. So a very, very unusual market. The S&P had a big finish on Friday. It was a big turnaround, but it still managed to finish down just a fraction, 0.2% on the week, but it certainly regained almost all of the earlier losses for the week. And yes, that was due to some data, some economic data, which suggested that interest rates may not go up as fast as people previously thought. But look, I think also too, it's just the market was really ridiculously oversold, and it was due for a bounce, and any old trigger would have done. So the S&P bounced off the 200-day moving average quite strongly, but it still remains squeezed in this triangle between the 50-day and the 200-day moving averages. And until it breaks out of that triangle, either way, then we've really got to be a little bit careful about how we tread in the market. There was a very big rebound from the tech sector, so that's a real positive. But we're also seeing continued weakness from the defensive sectors. So consumer staples, healthcare. I looked at consumer staples versus consumer discretionary last week and showed you the incredible divergence there, which is indicating that where the money is going, it's not going into the defensive sectors. So staples and healthcare are still not seeing the love from the market. Um, where it is going is more to the growth sectors. So that is where the big smart money is going. Yet sentiment is still very poor. So very unusual. The US dollar surged higher during the week, and that was really long overdue. So finally, I guess interest rate differentials do matter. I've been talking about this now for several months as the US dollar failed to respond to their rising interest rates and their stronger economy. But it looks like we may have seen a bit of a turn in the fate of the American dollar at the moment. So let's take a look at some price charts. Okay, so we'll start with the S&P 500, and you can see the blue line is the 50-day moving average. The red line is the 200-day moving average. This 200-day moving average is very important for the psychology of the market because millions of technical analysts define an uptrend as prices above the 200-day, and if prices are below it, then they define that as a downtrend. So it's an important psychological level, and we haven't closed below it yet, except just for one day here in a very minor way on the 2nd of April. And of course, the 50-day is also important from a short-term perspective. So you can see we're still squeezed in there. We've got this really quite tight triangle that's basically formed up here. We will get resolution of this one way or the other fairly soon. I don't think it'll be too long. It'll probably happen next week, I would think, because these sort of patterns rarely run all the way into the apex. So I think we'll get a breakout or a breakdown one way or the other based on fundamentals and the economy and the earnings. The break should be to the upside, but I remain open-minded that in the short term, factors, fears over interest rates going up too quickly, fears over the trade wars and negotiations with China could send the market lower in the very short term. But look, if it did, I believed it would be quite temporary and probably relatively shallow. Let's look at the Nasdaq now through the QQQ, and you can see we still remain in uptrend. If you pan back, you get a much better sense of that. You can see that back here we were basically tracking the 50-day moving average, just moving a few percent above it and coming back to it. That trend really is unchanged. If you look at the midpoint of that channel that we've now formed, so we've now got greater volatility, so we're swinging more to the upside and to the downside. But if you look at the current trend, the median trend through this period from February, it's really almost exactly consistent with what we saw throughout 2017. So there's really been no change there. Technology stocks have spent a little bit more time below the trend than above it, but that's to be expected because sentiment has been pretty poor. But the earnings season results have been nothing short of amazing. With Apple and Intel and Facebook and Amazon and Google, and the list just goes on and on. Terrific earnings reports and good solid outlooks. And there's been they've had lots of company as well. So things looking very strong in the tech space. Let's have a look now at the small caps. So this is the Russell 2000 via the IWM ETF, and you can see that again we've got basically a wedge pattern here. Unlike the S&P, and the Nasdaq, which is been trading in a basically an inclined triangle. This has been an inclined channel, I should say. This has been more of an ascending triangle. So in that way, the Russell 2000 is actually looking a little bit stronger, because this is more likely to to have a more explosive breakout, because we're building up momentum here as we attempt to break these all-time highs. So I wouldn't be surprised with a little bit of an improvement in sentiment if we see the Russell do a pretty decent breakout. Now I just want to show you some price charts just to underscore this point. So you've had a good look at what the S&P, let me just go back and refresh. So this is what the S&P looks like. So burn that image of the last 3 months from February, burn that image into your brain, and now look at what some parts of the market have done since February. So here's the line in the sand. So you can see this is, and don't worry about what these stocks are. They're not recommendations. It's merely to illustrate the point that some sectors of the market are grossly outperforming the indices. So there is one. There's another one. This is another energy stock. There's the end. That's the start of the February correction. This virtually didn't go down at all, and it's now just gone straight up with some very good earnings. Here's another one where, let's get to the end of February. So there's the end of the correction. There was virtually no reaction to the correction at all. And now look at the performance of the stock. It's moved from around 35, 36 to 43. So one of the ways to make life easier for yourself during corrective phases is to be focused, as I've been talking about now for years, is to be focused on the strongest stocks in the strongest sectors, because often there almost is no downside reaction to the correction, to the general market correction, and the price then just continues to march on higher. Here's Intel. Broke out of a very, very substantial base that formed here from 2014 through to September of last year, and you can see how quickly that has moved up. But let's look at the period from the start of the February correction. There it is there. So Intel went down from, say, roughly 49, had a brief run down to 43, but now it's trading back up at 53. So that one's been quite strong. Microsoft, here's the end of the February correction. Microsoft is trading higher than it was before the correction. And this is the final one. It's in the mobile payment space. This is the end of the correction. It was only a couple of days down, and then the price just charged off again. So I really want you to take on board this concept that you shouldn't just look at the market through the lens of what the index is doing. And if the index is going down, then don't get caught thinking that all stocks are going down and there's no opportunities, because there are always amazing opportunities if you're organised and you know where to look. Okay, the Australian stocks. The Australian dollar fell down to 75.3. It even dipped down to 74.7 intraday on Friday. Our index gained 110 points for the week, was very solid, was the 5th weekly gain in succession. And the banks have basically retested their breakdown level. They ran a little bit over it and then turned down again on Friday, and I'll show you what I mean by that. So first I just want to look at the US dollar. So let's pan back. So there's the US dollar. It managed to hang on to this critical support here around 89, which tied in with these previous peaks back in 2009 post the GFC. And you can see we've now moved back up to what is a short-term resistance level. So it'll be very interesting the next week or two. But clearly we broke out of this consolidation base and move sharply higher by around about 4 or 5%. So the next week will be important because of breaking this resistance. The Australian dollar has gone the other way, and we were trading at 81 cents in January. Now we're trading down around 75, and fundamentally really should be more like 70 or below. Turning now to the ASX 200. So we've managed to scramble back above 6,000 points, as you can see there. So we definitely had a triangle on our hands that the index broke out of. So we can remove that now. So we've had an ABC downward move. There's the A leg, there's the B counter trend, little rally for a couple of days, and then the C leg played out, and then we've got this amazing turnaround, which is really driven by both mining stocks and also by the financials. Let's just look at the financials. So this was an important breakdown. As you can see, this was a critical level around 6,200 points. We broke below it, came back, retested, went down, formed a slightly lower low. We've now retested it, but turned down again on Friday. So at the moment, you can say that the 200-day, irrespective of what you think of the banks, you can say that the 200-day moving average is now pointing down. The value of the index is now consistently below the 200-day moving average, as it really has been since around the middle of last year. The 50-day moving average is now pointing down, and the price is below it. So by all definitions, the Australian finance sector is in a downtrend. Now let's just take a look at CBA on a weekly basis. And I started looking at this chart about a month or two ago. So this is on a weekly chart. You can see we've got a really critical sideways channel here, and we're sitting right on the base of it at the moment. If CBA were to break down, and it really hasn't lifted very much in the last week or so, if it breaks down from here, then you're going to see the whole finance sector and the ASX 200 index, I believe, continue to move in a downwards direction. This is the materials. So this is BHP and Rio essentially, and they've had quite a strong couple of weeks, but they're still well below all-time highs, which were formed in 2011. In fact, that's not so. The all-time highs were in 2008 at around 17,000 points. We then had a lower high in April of 2011 at around 15,000 points, and now we're still down around 12,000 points. So we're still a long way off the highs. And just looking at energy in the Australian context, so this is heavily reflected by Woodside, of course, and Santos. So we're still also a long, long way below the all-time highs in energy, but definitely an uptrend. So this industry group within Australia has been moving up now for a bit over 2 years. Turning now to precious metals, gold was lower by $10 down to $13.15, and that was really largely just moving in line with the US dollar. Precious metal stocks, however, whilst they're not really doing anything of great note, they are doing a little bit better than the metal, and that's really what you want to see. You want to see stocks moving ahead of the metal, not the other way around. If stocks are going down and the metal's going up, then you know that metal's not going to go up for very long, because stocks almost invariably lead the underlying metal. The Australian stocks, however, gold stocks have done extremely well, and I've mentioned these to certainly to all members of my my paid services, and particularly in Portfolio Analyst as well. So let's take a look at gold on a weekly basis. So you can see we're still in an uptrending channel, but we've come off in the last week or so just a little bit. The daily chart, little bit of a rebound on Thursday and Friday, but generally down for the week. Now, turning to, rather than looking at GDX, I'll look at Newmont this time. So look at an individual stock. So this is the, I think it's the second biggest gold miner in the world. And let's just get a decent slice of action. So Newmont's all-time high is around $70. Big rebound in 2016 in the first half. We then fell back from around the mid 40s, fell back to the low 30s, but now you can see there is an uptrend in progress. It's fairly slow, but nevertheless it is an uptrend. Turning to other commodities now, copper was steady at 308, which is pretty good because of the US dollar being higher. Would have put downward pressure on copper. But crude oil, I guess, was the big story again, almost surged to $70. And that's pretty impressive considering that it had the weight of the US dollar on top of it. So the crude oil price is moving very strongly. Stocks were steady. They didn't do a great deal, but then they'd had several months of pretty good gains. So stocks still leading the way as far as I'm concerned, and that's a positive. There's the spot copper chart. There's the oil chart. You can see we've got a very, very strong trend here over the last basically 3 months. We've moved from around 58 and we're now almost to 70. So just to wrap it up, earnings season continues to deliver. Apple was a great result. And it also comes to light that Warren Buffett has been adding about 75 million shares of Apple to his portfolio during the first 3 months of this year, and that gave the stock a bit of hurry up on Friday night as well. But I mentioned all the other technology stocks that have also come out with terrific earnings. Portfolio analyst this week, I'm going to be looking at using some of the fundamental analysis work that I do, looking at stocks to buy, but also stocks to avoid, which is as equally important. If you can sidestep the stocks that are perhaps an accident waiting to happen, then that's a real positive step as well. So that's it for this particular rundown. There's my contact details for anyone that wishes to communicate with me. Please don't ask me very specific questions about certain stocks because it's not my position to answer those. I'm not allowed to for licensing reasons. Yeah, I make the opportunity to communicate with people if you're looking for guidance on how to start, or if something in the market confuses you. So that's really the purpose of that invitation. So that's it for this week. Cheers.